Let's continue the conversation with Trivariate Research founder and CEO Adam Parker, who's here at Post 9 and has been a little more cautious on the market, right? You what, went to neutral on stocks?
Well, I mean, I think the banking crisis is probably bad for loan growth. Tightening financial conditions aren't great. But, I think most of the conversations I've had with investors recently have been, what am I missing? Why is the market so resilient? What is the bull case besides something around positioning and sentiment? Is there something underneath there? And so I think a lot of us are trying to, create a belief that we could be 10% up in a year, and what would cause that. I mean, obviously, you guys are focused, and a lot of people on 2 p.m. today and the conversation around it. But I think if you're investing and you're looking out toward year end farther.
What would cause us to go up 10%?
Besides positioning and sentiment, I think it's got to be...
It's always positioning.
Yeah, that's always the throwaway, because I think if you look at valuation or equities premium or other asset classes or earnings expectations, it's hard to tell a sexy story about U.S. equities. I think that's a challenge. So people are going to say, well, there's a fear of missing out and the flows and all that. But I think there's some logic. I mean, we wrote a big note a few weeks ago about AI, and it's kind of come a little bit to fruition this earnings season, where companies are telling you we're starting to see some real path. So what we did is we typed into ChatGPT, give me terms related to AI. We got 15 terms, artificial intelligence, neural networks. And then we used language processing to search the biggest 200 growth stocks transcripts from this quarter and sorted by the ones that reference it the most. Now, maybe the referencing and don't have anything, but you look at the names of the videos at the top of the list. And we created a basket, and we looked at the performance of the growth universe X AI, and AI's beating it, and I think it's real. I think that if you're saying I'm investing in your personal life, you want to not touch it for 5 or 10 years, you definitely do not want to be short AI. You want to assume that tons of human behavior is going to get commoditized by it. So there's some things in the growth universe that are attractive underneath.
It may be a generational opportunity, the same way the internet was. But of course, I can think of a lot of companies in 1998 that weren't around in 2001.
There's the lightning bolt. There's the but I think there's the other side of it. Interesting conversations is, well, what about things that aren't AIable, right? Like, I'm still going to want to travel, and the virtual honeymoon doesn't replace the actual one. I'm still going to eat, use utilities. You think about what happens in my house when the Wi-Fi is down, nobody can function. So there's got to be some staple-like things that maybe will create at a higher and higher multiple because they're not AIable. And maybe you have some bimodal distribution of 2 different types of stocks that are worth 40 times earnings because they're just kind of where the world's heading. So there's some thought out there about maybe, not all of this is just, people got dovish about the Fed and growth stocks ripped because of, Fed fund futures. That's some of it, for sure. But I think underneath it, there's some real things that are happening that are starting to, change the probability of outcomes. Look, our job as equity investors is look at a range of outcomes and sort of say what's in the price and is it dislocated. So I know the popular press can say, well, it's all short sellers. But, I don't know, if I'm a short seller, I'm looking at a distribution of outcomes where banks can go down a lot. I'm going to short some of those. Why not? Until the government comes in and says the deposits are safe, it's been pretty good alpha generation the last month or two. So I think it's distribution of outcomes that people are focused on. I think there's some positives underneath.
There's another group on the AI front. You mentioned those that are the beneficiaries, those that are AI proof. There's also those we learned yesterday that are getting disrupted by AI. Sure. And we saw the Chegg quarter and the reaction there, where ChatGPT is now a competitive threat for them on homework help.
I mean,
how do you figure out who else
as a father of some, kind of college students and high school students, I can tell you they're all trying to figure out which teachers understand what ChatGPT produces and not, and they all used Chegg during COVID, so none of that surprises me. I was just a little surprised that wasn't in the price on that one. But I agree, there's tons of other businesses like that. Look, I think the trickiest one's software, because there will be some AI that will produce some software that will obsolete the need for some software programmers. So that one's a little bit of a weird one, right? So, but I kind of, and I think this is where a lot of people are thinking I'm investing in, for.
And where do you stand though on the larger macro issue of productivity enhancement from this technology, and whether it really will start to show up? And when?
I've been thinking a lot about, not to reference another network, but the 60 Minutes interview with Google CEO a couple weeks ago, where he talked about hallucinations, which is, AI produces 5 books on inflation and none of them exist, right? So there's still a long way to go. I mean, for me, somebody like me, the holy grail would be, I basically take all the information real time that's out there, have access to borrow, risk, and anonymity, and trade on it immediately, and I win, because I'm processing the information. But when there's all these kind of hallucinations and crazy things happening,
it's being used as a productivity tool right now.
It is, and it will continue to be. And I don't know if it's 10 years or 20 years, or if it's 10% or 50% of human behavior, but that's kind of my current box.